people nowadays, they don't care about gold, they don't care about silver. What they really care about is the hot new, Trump coin.
The thing about crypto is that there's only one truly credible project, and that's Bitcoin. And there are two things about MicroStrategy, in my opinion. A lot of people disagree with me. It's got a huge bullish fan club. It's like GameStop. It's one of those situations where it's doing financial alchemy, which could only fail in the end. So I think that the rest of the world's got a big opportunity. In the same way everyone's investors are underweight gold, they're massively underweight China. It strikes me as pretty obvious that the rest of the world will have a catch-up trade. I don't know how long it lasts for, but certainly that feels like a good theme for 25.
Welcome back to the Gold Exchange podcast. My name is Ben Nadelstein. I am joined by Charlie Morris, founder of ByteTree, which is an investment research firm that covers both traditional finance and crypto. But I want to say Charlie is, in my opinion, one of the loneliest investors in the world because he is someone who appreciates gold, Bitcoin, and even the paper system. So he is a truly unique perspective in today's modern world. Charlie, welcome to the show.
Nice to be here, Ben. Thank you for the invitation.
Charlie, hopefully I can make you a little bit less lonely today. So let's start with some of our main topics, which is gold, of course, on the Gold Exchange podcast. You've written about the super bull market that you think could be happening in gold. Let's talk about the silent super bull market in gold and what's the main difference.
So, good question to open it up. I've been covering gold in a publication called Atlas Pulse, which I've been writing since 2012. And I've been, for 13 years before that, I've been a fund manager trading gold and stuff. So I've been in the gold market. I'm not in the gold market, but I've been a friend of gold for 25 years. And last month I published, as you just said, the Super Bull. And I was really trying to differentiate this gold bull market from the last one in particular, the 2000 to 2011 bull. And it's very different than that time. And really, because you could say that the gold has been behaving somewhat like a bond proxy for a lot of the 21st century. And, obviously real interest rates, so you could really look to 20-year tips. But that all broke a couple of years ago, and I'm sure you've heard this argument many times on the show in recent years. But if you look at the fact that the bond market's collapsed and gold's carrying on being extremely strong in the last couple of years, or particularly 2024, the last time we really saw that was in the 70s, when the bond market was terrible and inflation rose. And when inflation goes up, bond yields go up. And the antidote to that was gold. And I think you have to go back and think, what is gold? Not the metal and all that, but, as a financial asset, what is it? And the truth is, it's changed its spots so many times over so many years through different regimes and different places and times in history. Most of the time it's been fixed in some way or other. But more recently, it's gone through this huge transition since 1971. And I think that what we're seeing now is a repeat of the 70s, which is, gold is the antidote to a weak bond market. What do you do if you're a fixed income investor? You haven't got a lot of choice, have you? So gold is one of the alternatives that you can look to. And then I just published today being Thursday, that not only is it a super bull market, not just a bull market, but it's a silent super bull market. Or did I call it a super silent bull? Can't remember. One or the other. And the silent bit is no one's talking about it, apart from us lot, gold people out there. We all know about this, but the mainstream are not interested. And I demonstrate that with the fact that the silver price is very, very low compared to the gold price, and the price of gold mining stocks are very, very low compared to the gold price, and the fact there've been hardly any inflows at all. In fact, there've been 25% outflows in the last 5 years, and the gold ETFs just turned the corner a little bit. Outflows from the silver ETFs, and 10 years of outflows from GDX, the gold mining ETF. And so you put all these things together and say, where the hell is everyone? Where are the normal gold monkeys? And I didn't really cover it that much, but I think a lot of if you could remember the 2011 bull market in gold, all the kind of crypto type people you see today would have been in gold, right? Talking about silver and that sort of thing. And today their attention is taken by Bitcoin, Ethereum. I didn't cover that point in the article much at all, actually. But the bottom line is, it's a quiet bull market. It's a super quiet, low sentiment, nothing crowd about it. And that's really, really, really bullish, because there's one thing that ends a bull market is everyone's on board, right? The shoe shine boy and all that. We're so far from the can't even say it, the shoe shine boy. We're so far from that moment. And so this is a super bull market that's silent.
So let me take the other side of that. Let me be the contrarian here, which is that Charlie, you don't understand. People nowadays, they don't care about gold, they don't care about silver. What they really care about is the hot new, Trump coin or meme coin or some cryptocurrency investment. And the people who are the new money are young generations who are putting money into their 401k, and they want MicroStrategy and they want Bitcoin ETFs. They don't care about gold and silver. So is there a chance that because this bull run is potentially silent, that it doesn't actually get into the mainstream? You don't see mainstream investors. Is that a risk?
That's not a risk, that's the opportunity. So the longer it remains silent, the longer it continues. The quiet bull markets are the best bull markets. When everyone's shouting about it, when everyone knows what AI is, then it's over, right? Do you remember 2 years ago, no one knew what AI was? There's the announcement, AI, ChatGPT. What are you talking about? What is this thing? Then it goes up 10 times and everyone suddenly is an expert on AI. And so the very fact that no one's talking about the gold bull market underpins it. And I would say there are many more pseudo experts in crypto today than there are in precious metals. That's really bullish. Where are the silver bugs? Where are they? Or the silver stackers, or I can't even remember what we used to call them. But the fact that they've all gone underground is fabulous. I mean, I also showed a chart, for example, in the piece of the gross margins of the GDX index collectively. I don't know how Bloomberg calculates it, but I'm sure it's approximate, but quite good. And, with the gold price high and the oil price low, which is a major input to mining, the margins should be way higher. And so, we're going to see massive upgrades in the gold mining sector this year, in 25. And so that's going to be exciting. And so there's so much to look forward to. Now, as it happens, we know quite a lot about crypto at ByteTree. So, I can speak on that side as well. But the thing about crypto is that there's only one truly credible project, and that's Bitcoin. And all the others are just sky high volatility. And I think that's the really important measure here, because, Bitcoin volatility is, 42% over the last year. Gold is 14 or something. Silver would be twice that, would be about 28, and the miners would be higher again. But the rest of crypto is just up in the stratosphere. And so, I think volatility is a really, really important measure for liquid markets. So obviously, you're talking about real estate, it's not important at all, it's useless. But in liquid markets, in heavily traded active markets, it's a wonderful measure of asset class credibility. And gold kills it every time, with this sort of this very, very low number, 14. Doesn't matter what the news is, whether it's really good, really bad, whatever. There's just billions and billions of dollars on both sides of the bid every day, reliably, always there. Price goes down, central banks, yes, please. This value buyer that never goes away. And you just don't get that in Trump coin, do you?
I guess you don't. I'm not an expert in Trump coin. Let's talk about what you think investors see when they see, okay, it's time to buy gold. So often investors buy gold due to market fear, geopolitic fear, inflation fears. What are the reasons that people are buying into crypto? Because we've often seen that gold and crypto move in opposite directions. So do you think there is competition there when, the next inflation print comes up or the unemployment numbers go up for gold, or do you think that they're really separate markets?
I think they are separate markets. And I've always said they're not negatively correlated, but have low correlation. And there is quite a big difference between those two things. I mean, perfect negative correlation is actually quite a desirable thing in portfolio management. You kind of want things to do that. And obviously, if you can rebalance negative correlation, then that's a really lovely situation. But low correlation will do. That's about as good as we get in investments. It's very financial markets. And, one of the reasons they're different is because gold is basically the bond market. It's the alternative asset for the bond market. And Bitcoin is the alternative asset for the stock market. And because it's an internet stock, Bitcoin comes from the internet. No shit, Sherlock. It replicates the tech sector more so than the utilities sector or the financial sector or whatever. And so, you've got this sort of tech. If you put, Bitcoin and gold are basically a bond equity portfolio for the alternative investor. And what's an alternative investor? Well, an alternative asset is crypto, it's commodities, Gold's the king of commodities, Bitcoin's the king of crypto. But there are sports cars, classic cars and art and wine. But these things are not liquid assets. Yeah, you could talk about oil being even more liquid than gold, which is true. But joking aside about it actually being a liquid, but in terms of heavily traded, but it's a futures contract, right? You can't have spot oil, right? In the same way you can't have spot gold. So Bitcoin and gold are very unique in that regard because they're the two assets which are hugely liquid, which can be held in physical form. And Bitcoin kind of weird physical, but you know what I mean. It is what it is. You can't touch it, but you can prove it's there.
Let's talk about that liquid gold and liquid Bitcoin market. So, the Bitcoin ETF has seen incredible inflows, but some critics are saying this is actually an issue, right? There's a centralization aspect about Bitcoin that they were trying to get away from, and this ETF kind of squashes that whole bid. Gold has also been totally transformed by the ETF space. So, do you see the Bitcoin narrative and the ETF being an issue? Or do you see it similar to gold, where this is actually a benefit to gold owners having a different form in which they can have gold in their portfolio?
Well, they're both a benefit to both asset classes. I mean, to say you don't want ETFs is absurd. Why would you deny capital from your asset class, assuming you want it to be successful? So you presumably anyone with half a brain would want the capital into the thing. Some big company like Fidelity is trying to allocate to Bitcoin. Well, Fidelity is a bad example. They're quite expert on digital, but you know what I mean. Some big asset allocator, they're not going to put money into some wallet in cyberspace. They want someone who's expert. They want iShares in the middle to cover their back, and that's makes total sense. And it also solves a legal problem because a ETF has an ISIN number, which can then go to your custodian. You've now got a price, and you can value your portfolio efficiently every day. And gold was obviously the precursor. 2003, Australia, the first big gold ETF, and that launched to solve that legal problem of how the hell do you put gold into a portfolio? Well, I'm a fund manager. I put the gold in my drawer and say, yeah, the client that's yours. It doesn't really work. But the sort of the custody system of gold is highly efficient and it's been refined over many years with the bullion system, the vaulting system, and that sort of thing. So they're both. It's been a huge enhancement, and I would say that approximately 1% of all the gold in the world is sitting in an ETF vault, and about 6% of all the Bitcoin in the world is sitting in an ETF vault.
Now, let's ask you, the world's foremost expert, on the Swiss ETF Bold. So, this combines Bitcoin and gold in a risk weighted structure. So, I'll have you explain to our audience what that is and how it works.
Yeah. So I've been a portfolio manager for many years, and I came up with the idea of mixing Bitcoin and gold together some time ago, because originally I'd thought about mixing momentum stocks, tech stocks, momentum stocks, those kind of things, with gold on a risk-adjusted basis, and it made sense. And I did the test, and this is really quite a good idea. And then eventually, the penny dropped that the way to really do this was with Bitcoin, because Bitcoin basically is highly correlated to the tech sector. It's got a bit more juice in it. So I think it's got a higher Sharpe ratio than the tech sector. In other words, you get a bit more return for the amount of risk you're taking. That's generally been true over reasonable periods of time. And so, with that instinct in mind, this is the most efficient way to invest in alternative assets, because you can go and buy paintings and things, but they're not liquid, as I said. So you've got no two-way market. But with Bitcoin and gold, you've got two hugely liquid assets. One's a bond, one's an equity. You put them together, and hey presto, you've got a diversified output. And so, but how much do you have of each? Now, if you go 50-50, then that doesn't make any sense, because obviously Bitcoin is riskier than gold, right? So it's got to be more gold than Bitcoin. And then you get some sort of financial maths textbook, and you go, inverse volatility weighting, and you look at all the options around that, and you go, well, hey presto, that's what we'll do. And so you could choose 30-day vol, looking backwards, or 90-day vol, but actually I chose 360 because I'm not looking for a tactical signal of volatility. I'm looking for some sort of measure of the quality of the asset class, right? So gold's volatility was really sky high in 1979 at the top of a generational bubble. Yeah. And Bitcoin's volatility was sky high at the end of 2017 after a generational bubble. So both asset classes, happen to Bitcoin a lot, occasionally to gold, have had their moment. And when you have those times, those assets are riskier than they would be when their volatility is low. It's a pretty straightforward argument. And if you run the maths of the inverse volatility weighting, it's a very simple calculation, which we do every month. It's run by our independent index provider, Kaiko, and they're based in Sweden. And you end up with, roughly speaking, 3/4 gold and 1/4 Bitcoin. What you're saying there is that if you had $75 in gold and $25 in Bitcoin, your chances of losing or making $10 in each asset class is roughly the same. Yeah. So, it's just a very simple, efficient way of doing it. If you wanted to use other weighting mechanisms, you could try and be predictive, but the truth is, it's really hard to consistently. Well, actually, it's impossible to consistently predict the outperformance for gold or Bitcoin. Sometimes it's easy, but generally, repeatedly, it's impossible. And so that's it. I say put them together, sit back and relax. And there's an alpha, because if you had this rebalancing strategy, one's always doing well. I mean, not always, but generally speaking, it's either a gold year or it's a Bitcoin year, and they take it in turns. 2022 was horrendous for Bitcoin, but gold held up pretty well. It was fine. They've both been quite strong recently. That's unusual. But take 2018, that turned into not a bad gold year. Terrible for Bitcoin. 17, terrible for gold, good for Bitcoin. And you keep seeing this counterbalance happening time and again, not necessarily on a day-to-day basis, but quite frequently when gold is, when Bitcoin is down 10% in a day, like it was last weekend, you'll see gold up 2 on the day. And so that you put that together, you lost 10 in the Bitcoin and you made 2 in your gold, and you got 3 times more gold than Bitcoin. Your volatility of your gold is not very high at all. So this is where the magic comes in, Ben, because the volatility of the gold index is approximately the same as gold. Slightly higher, but not much higher. Tiny bit higher. It should be much higher, but it's not. And then the return of the gold index compared to owning Bitcoin, which is, it's hard to say because there's just not enough years and data, but it's you're just behind Bitcoin. You're taking a fraction of the risk and you're just behind Bitcoin. So if you added leverage, you'd be ahead. So your risk adjusted return is way, way superior to owning either asset. So as a gold guy, you come in, a little bit of Bitcoin really enhances your position. As a Bitcoin guy, lots of gold totally makes you sleep at night. And you'll end up in roughly the same place 5 years from now, which is my opinion.
Charlie, if this idea works, I don't even want credit. You can just send me a gold coin or crypto Bitcoin in the mail. I don't even know how you send cryptos nowadays. But how about a similar model for gold miners and Bitcoin miners? So how should people think about the people who create gold and create Bitcoin? Is it a different way fundamentally to analyze the value of these companies? Or is it really something where you take the underlying and assume more volatility and more leverage?
So you couldn't put them together in quite the same way, because you both, you've got in gold miners, you're talking 40 vol probably for the index. The individual stocks, many of them be much higher. Bitcoin miners, be 100 plus. It'd be MicroStrategy kind of stuff. Nuts. Could you apply it to them? I mean, I suppose you could, but I don't think the outcome would be as impressive as we'd like it to be. I mean, I think one of my issues with Bitcoin miners, and I'll probably get shot for saying this, is when you know that your production's going down over in the future. I mean, what's good about that? So as a Bitcoin, as an owner of Bitcoin, that's great. But as a miner, I mean, it's terrible. So you built your mine, lots of chips and sheds and electricity, and then we're going to get that much Bitcoin, then we're going to get that much, then we get that much. I mean, that doesn't sound fun. And in the real mining industry, you would walk away from that. Would you say, well, no, thank you. So I think they fundamentally do have a problem. I know they've done other things. They got involved with AI and they're in the electricity business, but let's face it, let's just focus on their core business, which is mining Bitcoin. That sounds like a tough gig to me. But the gold miners, I mean, that's you find some gold in the ground and you dig it out, and you know what your costs are: oil price and people, and governments and taxes and things like that. And then your revenue is the gold price. So it's a very simple model. It's a model that's been going on for thousands of years, to the beginning of gold. Gold didn't appear before chicken and egg situation. I mean, someone had to mine it. Um, and there you have it. So we know what that is. I mean, gold mining is a low quality industry in the sense that these are not super stocks like big internet stocks with massive margins and no cyclicality. It's quite the opposite. But I think there's always an opportunity when they're undervalued, which I think they are now. There's a really good couple of years coming in gold miners. Bitcoin miners less sure. I've looked at them closely. I just don't understand them. I can't see any profits anywhere. So call me old fashioned, but I do like this thing called profits.
Charlie, you are a hoot. It sounds like I should be keeping my day job. Okay, on to my next question, which is about MicroStrategy, which is recently rebranded to just Strategy. So they're using Bitcoin in some ways to kind of drive the stock and drive the narrative around their stock. So how should investors separate the signal from the noise when evaluating either Bitcoin related companies, gold stories that come out about the treasury and gold? How can investors think about separating the art from the artist, basically?
A lot of people disagree with me. It's got a huge bullish fan club. It's like GameStop. It's one of those things. It's got the man, and everyone loves it. Um, I don't. I can't bear it. Um, it's one of those situations where it's doing financial alchemy, which could only fail in the end. Yeah. And on the other hand, the whole thing is being driven by regulatory arbitrage. All right. So why is there a MicroStrategy premium? So you have $40 of Bitcoin, and MicroStrategy shares are $100. That is the outcome, right? So investors think they're buying leveraged Bitcoin. They're going to get more upside than Bitcoin. Well, no, you've got deleverage. Firstly, so you're paying 100 to 40. That's not leverage. The other way around. If you had 100 of Bitcoin and you're paying 40 for the shares, that's leverage. Like for example, GBTC, Grayscale Bitcoin Trust, 2 years ago, 3 years ago, before it became an ETF. That's a leveraged opportunity because you're paying half of NAV to get in. So you did twice as well as Bitcoin. Fantastic. So in the long run, MicroStrategy shareholders are going to underperform Bitcoin because it trades at a 150% premium to NAV. One. Two, the premium has enabled them to issue stock. But the problem with issuing stock is it kills your premium. If you issue too much stock, then there's too much stock in the market and your price will come down. So you don't want to do that too much. So they find other ways. So they go to the convertible bond market. And then how do you keep the convertible? How do you excite the convertible bond market? Well, you keep your volatility high. So MicroStrategy shares were 140 volt, 140. That's what Bitcoin was in 2010. I mean, sorry, 2012. Yeah, when it was a little thing. Yeah. And this is a $100 billion market cap or something like that, last time I checked. And so you've got this massive market cap with this huge liquidity and this huge volatility. And then the convertible bond market people like the vol because they can take this bond with no coupon. So obviously it looks like it's cheap finance because it's got no coupon. But then they take this bond and they do their convertible arbitrage thing, which basically means that you buy the stock and sell the vol or something like that. And anyway, you end up with this valuable volatility in the options market. You can turn that into options and stuff. Now, but the volatility won't last. And one of the feeders for the volatility has been the 2x, 3x, 5x MicroStrategy ETFs with these huge flows each day, bang and bang, bang, bang. And there's all this excitement. He's used the capital structure in every single way, issuing converts, and they started with debt and issuing shares, and now this. And it just keeps going and going and going. And it's like every bit of corporate activity you've ever seen in history rolled into one stock in a short space of time. And perpetual motion, and Matt Levine and Bloomberg did said a few words on this thing. He described it as the perpetual motion machine. And the reason it can't work is because there's no alpha. Yeah. You issue shares, you buy Bitcoin, fine, but there's no alpha in that. You've just issued shares and you bought Bitcoin. Yeah. If you borrow money and buy Bitcoin, you're now leveraged. Okay, if you do a convertible, are you leveraged? Well, yeah, okay, but it's not a high risk leverage. I accept that. And maybe the borrowing terms are good. But it all hinges upon the idea that this thing's just going to get bigger and bigger and bigger. And it just can't, because the premium doesn't deserve to exist. So the only reason the premium is going to stay high is because you're going to have you're going to have excitement to buy Bitcoin forever, never going away. And none of these countries that have banned Bitcoin, like my country, the UK, you cannot buy a Bitcoin ETF in the UK. You cannot buy a Bitcoin ETF in Thailand. You cannot buy a Bitcoin ETF in Japan. There are quite a lot of countries where you can't do it. So they buy MicroStrategy. And if you look at the most popular online brokers in the UK, for example, the most traded stocks, it's MicroStrategy. It's people trying to buy Bitcoin. Yeah, there's the proof, you know. And the regulators have banned the ETFs, but people buying MicroStrategy. It's a regulatory arbitrage. There is no alpha in the perpetual motion machine, and it's going to end in tips.
Let's talk about this idea of a strategic Bitcoin reserve. The US has now said they are interested in looking into having a sovereign wealth fund. So, do you see gold? Do you see crypto? What do you see in this potential sovereign wealth fund? And do you think this is something investors should seriously consider when allocating to their own assets?
It's a strange thing because the US is a great almighty country, obviously, but it's also a country with lots of debt. The countries with sovereign wealth funds are the countries with no debt. So, it's Saudi Arabia and Qatar and these people with huge amounts of money and no or minimal debt. Norway, Singapore, tiny amounts of debt compared to their assets. So it's a bit of a strange thing, and the UK has done a very small one, a really tiny one for renewable energy. It's really pathetic. It's embarrassing, actually. But the US is going to do something because it's Trump. It's going to be big, and it'll be quite fun. But I don't know what he's going to do with it. I would, for your sake, I hope he doesn't buy Bitcoin. I'm a Bitcoin bull. I like Bitcoin. I get it, but I really don't think that governments should be doing strange things like this. I think the gold market is what central banks should be doing. Sovereign wealth funds are free to do whatever they like. I mean, I accept that. But if it's just sort of a sort of vehicle to ramp Bitcoin in the short term to get everyone excited for the electorate and stuff, that's a really bad idea. So whatever the sovereign wealth fund does in America, I hope they just make good long-term decisions and build some infrastructure or whatever needs to be done to make the world a better place or America a better place. That's what they should be doing, not tossing around in Trump coin. That would be very disappointing, and it would just send the wrong message. These people are just spivs. That's how I would see it.
So, do you agree with this saying, which is the US innovates, China
Yeah,
imitates, and the EU regulates?
yeah. I think 100 years ago we said the UK innovates, the US imitates, and someone else said the world keeps moving. So that's how it feels like at the moment. And China, I would argue that the only issue with that statement is I think that China is very much in innovation mode now. They're much more sophisticated than people give them credit for. It's normal for an emerging power to imitate. It saves a lot of time. Since Deng Xiaoping did his reforms in the late 80s, you can't imagine they've invented everything that Western society has invented over 200 years in the space of 3 or 4 decades. It doesn't seem very likely. So they have copied a lot. Of course they have. Um, but I would say that we shouldn't underestimate the power of China. They are a force to be reckoned with. And for example, they're just ahead in so many areas. Everything to do with energy and cars and now we've had the story about AI doing it more efficiently. No one's quite sure what it means or who said what. But the point is made that these guys are not making rubber dog shit anymore. Like was the joke in Top Gun 1. Um, and they really are. They are making cutting edge stuff. And so I think that that there's going to be a world with Europe in the middle, sitting there looking at finding its soul, wondering why we regulate everything and how we used to, we sort of invented the modern world, but then let it slip by us with America on one side and China on the other, these two great powers. I think there's a lot of soul searching in Europe. And I think that with success, you breed socialism. And now the socialists of Europe, and thank God for Trump, because the socialists of Europe are just looking at that, and everyone can suddenly say what they've always wanted to say.
Do you
And that's very positive.
Do you think there is going to be a soul searching, a turnaround in the investing horizon for investors looking to invest in the EU and the UK, or is the main action going to be in markets like China and the US for now?
I think the US has had it too good too long. The dollar's expensive. US stocks are expensive. The rest of the world is so much cheaper. It's not normal for the US to outperform for decades on end, like it has done since 2008. The US, for example, between 2001 2008, massively lagged the rest of the world. So these things go in cycles. The most important component of that is the dollar. The second component would probably be the valuations of those markets. I think what doesn't matter that much is the macroeconomics. It matters much less than everyone thinks. And the rest of the world, you've got the valuation. I think the dollar has overdone it. I think Trump policies will end up being negative for the dollar because he just growth is the number one thing. And if you're an American citizen, the one thing you don't notice is a falling dollar. Yeah, you can have this, that, and the other. You can have low interest rates. You can have that. You can have everything, but just don't notice the dollar. The silent dollar bear market, we'll call it, when we write about it in a year's time. And that'll be good for gold, good for Bitcoin, and everyone will be happy. You know, um, and the alternative is really hard. It's to actually generate real wealth and the dollar go up further, and to actually get the profits of big US companies to catch up with their valuations. That's far too hard. Much rather go the other way and just sort of keep everything looking good and let the dollar slide a bit. So I think that the rest of the world's got a big opportunity. In the same way everyone's investors are underweight gold, they're massively underweight China. I'm pretty sure they must be underweight Europe. And so, Asia in general. And so, it strikes me as pretty obvious that the rest of the world will have a catch-up trade. I don't know how long it lasts for, but certainly that feels like a good theme for 25.
Let's talk about Trump and his policies. Obviously, tariffs, inflation, a lot of people talking about that in the news. Do you think these tariffs are basically just a big stick that he can use to negotiate with other countries? Or do you think investors should start positioning for tariffs and potentially more inflation?
Well, I was very surprised that China only got 10%. And then the joke in the UK is that he said that the UK was okay; they wouldn't get any tariffs for now because he was getting on well with the Prime Minister. And of course, they hate each other, but they're pretending to love each other. And the joke in the UK is the US administration couldn't identify anything the UK made these days, so there were no tariffs. And it's a sort of sad but true statement. And I think that it strikes me that they are going to be policy tools. He loves to throw these ideas. I love the whole Gaza thing. The problem with Gaza is there are a couple of million people there, and every time you leave them there, they start another war, right? So if you remove the people and put a Trump golf course and hotel there and a casino, then you solve the problem. And it's a very sort of innovative. People sort of go, "Wow, he's got a point," you know. But it's obviously something you could never say. Only Trump could say it, and that's the sort of comedy of the situation. And it gets everyone, and I don't even know if he's serious about it or not, whether he's joking or whether it's just to sort of break the ice and make people think outside the box. So there's all those sorts of issues about how he wants the world to be. But the way I see it is I think that Trump's view of the world is America is Greenland and Canada and America, USA and Mexico. And the rest of the world is just Area 13 in the Hunger Games. And, they can just send some copper over every now and then or whatever. So I think that's I think a slightly cynical view, but this lovely idea that that's the land of fertility and wealth, and you've got these two great oceans protecting it, and we want all the rich people and all the clever people to come in, and the rest of the world just stop fighting. That's sort of how I feel is how he sees the world.
Okay, let's get into a lightning round. So, what I'm going to do is I'm going to ask you a bunch of lightning round questions. You have the opportunity to answer with one word, as short as you want, or you can take your time and really go into quite a long tome on each. Obviously, these are going to kind of leverage some of your expertise in the crypto, the gold space, and just some fun ones as well. So, let's start with gold and Bitcoin in 2025. What do you think the biggest risks to gold and Bitcoin prices are over the next year?
A huge dollar rally.
Huge dollar rally. Next one. What, if anything, could send gold to zero, and what about Bitcoin?
Bitcoin could go to zero because of something to do with computers that we don't currently understand. But I think that's impossible. I think it could go to 0.0001 cent, but I don't think it can go to zero, um, hypothetically. And then gold, I don't know. I don't buy the meteorite thing, nothing.
Love it. Bitcoin is not crypto. Do you agree or disagree with this statement?
I agree with the sentiment of the statement, but technically they're all crypto.
Next one, when will other cryptocurrencies stop moving in lockstep with Bitcoin? For example, gold and silver have distinct dynamics from copper and steel. Do you think that cryptocurrencies will start to kind of move separately from Bitcoin?
That would be a sign of maturity in the sector. I look forward to it. You already see exchange coins behave slightly differently from other types, mem coins. There are different subsectors within the thing. But I take your point that the overall crypto correlation is higher than it just should be if the asset class is to be taken seriously.
You've said that large cap dominance is both rare and dangerous. So, can you explain why and what that means for stock market investors?
Yeah, well, we've seen it in 1929, 1972, and 1999, 2000, and now. If the S&P is half of its 26 stocks, half of its 474 stocks, that's an anomaly. That's not right. And when you have that situation, it's because the market momentum has got too much wealth concentrated in too few stocks. And this is not just the S&P 500. It's also about the argument about the rest of the world versus the USA. So there's been so much money going into a strong dollar USA, and in particular with the advertising campaign, the billboard being Nvidia, buy Nvidia here, all the S&P. And so all this money's come in, and then it's a bit like a really fat guy jumping on a waterbed, and you've got a couple of kids on it, and when the fat guy just sort of dives on the waterbed, the kids go through the ceiling. And it's one of those sloshy things with the whole money going out there and coming back, and the rest of the world, the small caps and the mid caps, these are the little kids, and the big stocks are the fat guy, and there's a rebalancing coming there, and that's how I see it.
Let's talk about that volatility. So, obviously, volatility is bad for coordination, just in terms of economics. But how can investors think about and prepare for what is seemingly going to be a volatile next 4 years?
Volatility. Well, if you want to have less volatility, then invest less. Have more gold and less volatile assets. That's pretty straightforward thing to do. So you can split assets into asset quality, and asset quality can be measured in various ways. I think a very simple technical measure is volatility. So I've already said that the high quality assets have low volatility. So a 1 year treasury has a very, very low volatility. And as you go up the curve, you end up with MicroStrategy at the wrong end of the spectrum. And then if you think of Johnson and Johnson or Procter and Gamble, or Berkshire Hathaway, these sorts of companies have got 15% volatility, similar to gold, maybe a bit higher, but not much. So they're very high quality and quite predictable as a result. Procter and Gamble's profits, what will they be 10 years from now? Well, you can probably make a reasonable guess. But with a cyclical oil company or something, you have no idea. Or something that's sensitive to interest rates. You have no idea. So that sort of certainty, in advance. 9 times out of 10. I mean, strange things happen, of course, but there are things that are predictable and those that aren't, and the volatility is an expression of that.
How should investors think about allocating by age? So if you're younger, obviously they say, hey, lean more towards stocks and a little less towards bonds. And as you age, maybe allocate more towards bonds. So in this kind of new investing age, how should people think about allocating based on their age?
I would swap bonds and equities for what I just said, volatility, low and high vol assets. So I say if you're young, embrace the riskier assets, and if you're old, then have more of the steady assets, but they don't have to be bonds. They could be equities.
Next question. Do you think central banks will ever replace some of their gold holdings with crypto, or do you think they'll just add on to the pile?
Well, El Salvador's done it, hasn't it? I think someone else has, but I've forgotten who it was. Um, I suppose they might start doing it. It would be a big deal if the U.S. Federal Reserve did it. It would be a very, very big deal. But I think I've answered that earlier. I hope they don't in the short term, because I think it would just be playing to an excitable crowd. I mean, it's still banned in many countries. It would be a strange thing for a central bank to do. And don't forget, central banks' reserves are bond-like assets. They own bonds and they own gold. Yeah, they don't own, okay, some, like the Swiss one does, but generally speaking, they don't own equities. And so for a central bank to be taking on risk assets would be strange, because that's not really what you do with reserves. You can do that with the sovereign wealth fund. We shouldn't really be doing that with reserves. So I don't think they really should. I think gold is very much a central bank asset. I think that Bitcoin is for the general public, institutional investors, and so on.
Will Bitcoin market cap ever reach the gold market cap?
So that's 2 and 20, isn't it? Two for Bitcoin right now, trillion, and I think gold's, last time I checked, I think it's 20 right now. It must have passed 20 by now. But of course, people say that gold is heavily understated. The 205 or whatever it is, or 209,000 tons that exists. That number must be understated, because gold's been around a very long time. So 2 and 20. Does that mean that can Bitcoin outperform gold by 10x? That's what it means. Because obviously, if Bitcoin went to 20, gold would probably be at 50 or 100, or whatever. So it's actually quite a big job. I think the answer again comes back to the volatility. So you've got 14% vol gold, and if you were to have them meet each other, then I think you'd also have a volatility match, because the depth of the Bitcoin market would have got to the same level as the depth of the gold market. In terms, you could pick up the phone and say $1 billion of gold now, and there it is. Will just come. It's there. Yeah. Whatever you read on the internet, don't believe it. It is true. It's a hugely liquid market. You want gold, you can buy it, and it will come to your doorstep. And Bitcoin is also very liquid, but not as liquid.
Next question, which is gold-backed stable coins or gold-backed cryptocurrencies. Do you think this is mainly a gimmick, or do you think this is an actual real innovation investors should be thinking about?
Well, it's a real innovation that was the first done in 2013, so it's not exactly new. And there've been dozens and dozens of gold tokens, and it's good. It's progress. I think gold's the precursor to the tokenization of everything, because it's just such a simple thing. It's got no dividend. We know how to store it. We know how to account for it. The ETFs have shown that. And so you just swapping the ETF for a token. Why not? It's a good idea. It's a shame that it hasn't taken off as well as it could have done. There are no big liquid tokens in gold yet. I'm sure there will be one day. I mean, if you think that it's just the stable coin where you're replacing dollar for the Tether stable coin, you're replacing dollar for gold. That's all we're really talking about here. Of course, it should be out there.
Let's talk about Tether. Is Tether a systemic risk to Bitcoin?
No, I think it was dodgy, but there's just no reason for it to be dodgy anymore, because it's now so big. Most profitable company in the history of the world, isn't it? Is it $80 million revenue per person in the company? I mean, it's comedy. And, from just receiving all this interest. I think that Tether's amazing. There's just no need for them to be systemically risky. I think that the stablecoin industry will become something that needs to be carefully regulated in the future, because newcomers will come, and just like we had money market fund, it could basically a stable coin on the other side. One side's a token, the other side's a money market fund, and we saw what happened to them in the 2008 crisis. They broke the buck left, right, and center. So they just need to have the same regulation and oversight that the money market funds do.
Let's talk about the Bitcoin halvings. So, do you still see this as a major catalyst, or is this already priced in for all Bitcoin investors?
It's I think it's quite misunderstood. I think it really was bullish in the early days, and now I think it kind of removes the price ceiling, rather than, if you think of a price, two mechanisms. One, you've got the jet booster on the below the share price trying to go up, and the other thing, you've got a kind of ceiling trying to stop it going up. I think it raises the ceiling as opposed to put the rocket on it. And what I mean by that is that 100,000 Bitcoin 450 new Bitcoin a day. That's $17 billion a year, yeah, of mining revenue. Someone's got to pay for that. Now, Michael Saylor says, "Oh, don't worry about it. It just washes out in the liquidity." But no, it's a real network cost, $17 billion. Just like the miners gold miners have to get paid for the gold they mine, yeah. 2% of the 20 trillion is 400 billion. So the gold mining industry is 400 billion industry. Yes, reasonable amount of money, right? And for Bitcoin, that's 17 at 100,000 or 16.7 or something. And so you've got to see ETF flows. Yeah, because mom and pop can't pay that, right? So it's going to be proper ETF flows from serious investors, or Michael Saylor's convertible bonds or whatever. Has got to do that. And last year we got loads more than 17 billion, and that was great. And so you get price equilibrium when you've got 17 billion coming in and 17 billion leaving the network. Yeah. And so that's a very important way to think about it. After the next halving, to maintain $100,000, the miners only need to get paid half of 17 billion, 8.5 billion. And then 4 years later, they need to get 4.25 to maintain $100,000. So it gets cheaper and cheaper for the network every 4 years to maintain price levels. And I think that if you say, okay, Bitcoin's going to go to $1 million next year, or $500,000, whatever. Okay, fine. I agree with you. Of course it will go there. But it will only go there for 5 minutes, because it's very expensive to maintain $500,000 Bitcoin. You got to pay 5 times 17. You look clever, Ben. Can you do 5 times 17?
85.
Well done. So you got to pay $85 billion a year to maintain $500,000 Bitcoin. That's expensive. Which is which in 10 years, that's cheap.
Next question for you is this about central bank digital currencies. So, do you think these are an actual threat that investors should take seriously, or is this just kind of a central bank pipe dream?
I think the tech side of it is just a stable coin. So that's fine. But I think the bit we don't like is the fact that it's a snooping device. The socialists like it. The libertarians don't like it. And I'm with the libertarians on that one. So I would much prefer that central banks or countries in general regulated the stablecoin sector, like I said earlier. Look after these things, because they've got money market funds, which some idiot's going to come along and put some crap into it, and it's going to blow up. And so, provided you do that bit properly, then stablecoins are a brilliant idea. The central bank digital currency, in theory, has no credit risk, because it's just the currency. Yeah, it's just the fiat currency. Obviously, fiat currency inflates and all that, but I'm talking about here and now. So the central banks don't the same way that their government paper doesn't have any credit risk in that currency. So there has that advantage. But that would be a real problem, because if the Bank of England launched a pound stable, the CBDC, then what are you going to do with all the banks? What are the banks? Their job is to print money, and you'd have to reinvent the entire system. So there's a lot of questions that come out of that. And right now, I think the libertarian one's as far as we need to go. We say, no thanks, let the private sector do it. Let the banks issue these things. Let the fintechs issue these things, and we see where it goes. But we want an open and competitive stablecoin market, not CBDCs.
So, in my intro, I joked about you being one of the loneliest investors in the world because you like gold, crypto, and obviously the current market structure in some ways. So, how should investors think about the difficulties of actually having a contrarian investing thesis and sticking with it?
Sorry, oh, you mean, yeah, because my club is quite small. Yeah. So basically, gold bugs are quite a small group, and Bitcoin maxis are quite a small group. 90% of the world think both are nuts, and the Bitcoin maxis think that gold people don't get it, and the gold people think the Bitcoin maxis are spivs, and so you just got this sort of thing. And then I'm in the middle of these things, and so yeah, so I have no friends at all, Ben. I'm very, very, very lonely, and it's it's awful. I feel like Kim Jong Un.
Okay, next question, which is you are in many ways a contrarian investor. What's a contrarian take that no one else sees coming?
Um, oh, I think gold goes higher. It's all-time high, all-time relative high, all-time real high, and it goes higher. That's contrarian, because no one's doing it. So gold's not pumped until you start seeing all these silver accounts on Twitter reawaken. So when that happens, and that's the signal, it's like, okay, calm down here, take a break from precious metals. But that is a very, very simple contrarian trade. I think what is contrarian is one of those interesting things, because some people think it's something that's gone down a lot, right? So the video went down a lot the other day, so therefore that's contrarian. No, it's not. If it's on the front page of the newspaper, it's not contrarian, right? So the contrarian trade is the quiet trade. And so back in 1999, gold just wasn't even talked about. No one knew what it was. It was just, its only role in society was jewelry. There was no such thing as investment gold. It was just forgotten. And there are a few Canadians who just sort of carried on running their funds and stuff, and just sort of and just held out. And then the bull market begun. So gold in 1999 was a seriously contrarian trade, and the European central banks were selling it, saying this is just over. So but that's what it is. So I think actually gold is the quiet bull markets are the best bull markets. So I think the other one I would say is probably Chinese equities, maybe, as we said earlier, maybe Europe. Don't expect magic from Europe. It's not Nvidia, but it can go up a bit.
Okay, next question. Do you think interest rates are in a new normal where they remain slightly elevated, or do you think we're heading back towards zero interest rate policy?
New normal.
New normal. Okay. Charlie, as we head towards the end here, I have one final question for you, which is, what is a question I should be asking all future guests of the Gold Exchange podcast?
How much gold have you allocated to all your clients?
Great question, Charlie. Where can people find more of you, more of your work, and the assets that you guys use?
So you can find me at byte.com, BYTE tree, which is kind of a money tree, and a digital money tree. So byte.com is where my work is, and everything we do can be found there. If you on Twitter, I'm at Atlas Pulse.
Charlie, it's been great speaking with you. Hopefully, we can make you a little less lonely with this interview. And anyone who has any questions can absolutely comment on the bottom, and we'll send them straight to Charlie. Charlie, thanks so much.
Thanks, man.